Any use of this tape must comply with the rules and regulations of the Securities Exchange Commission and the state in which it is used. This is an economic update of Jack McCarthy, who is the co-managing partner of Lord Abbett and Company and the portfolio manager of affiliated fund.
Matt Schiffman, National Sales Manager, Mutual Funds.
Tonight, I have the pleasure of introducing Jack McCarthy. Jack McCarthy has been with Lord Abbett since 1960. He became the portfolio manager of the affiliated fund in 1972 and was made a partner in the same year. In 1983, he was made co-managing partner of Lord Abbett. He remains a portfolio manager of the affiliated fund, which is now $3.3 billion in size. He always gives an exciting presentation. Of course, the equity markets are off to a big start in 1987. So welcome, Jack McCarthy. Jack?
Thank you very much. I appreciate being here again at Payne Weber. I'd like to start off by saying that the major purpose of this new video is twofold. First of all, I'd like to engender, before I'm finished, the kind of enthusiasm that I have for this bull market that I have had since '82 and that I still have. And I hope it'll be catching on you as well as the people out there. And hopefully, in conjunction with that, the second thing I'd like to see accomplished is that people act on what I'm talking about. And so, in starting, let me preface all of the comments that will come up now with a statement I made before you folks 13 months ago on December 18th, 1985. I said to you, in August 1982, 4 years ago, with the Dow Jones sitting at 765, we are about to embark on the greatest bull market in the history of this country. And that before the decade is over, the Dow Jones will be above 3,000. At the same time, I said within the very next statement a year ago that the public is as far away from the equity market as it has ever been. And that throughout 1986, you had to develop a clear, disciplined, mechanical way of getting the public into the equity market. So they're not looking at all of the worries that they're looking at on a day-to-day basis. That once every 3 months or once every 6 months, blindly, they would step into the equity market one way or another. Now, for all of the account executives at Payne Weber who listened to me 13 months ago, and believe me, they've been very well rewarded, not only in the equity market, but also in the bond market. But as you see, on December 18th, 1985, the Dow Jones was 1542. And Friday, it closed at 2005.91, up 30%. For those that listened, the 30-year Treasury bond in December of 85 was 9.40. As of last Friday, it was 7.28. Clearly, the public who listened have been rewarded with a great experience. Now, before going into the multiplicity of things that are happening in the economy, try and put them in an array of order and easy explanation for people. And before I get into a real discussion of the financial markets themselves, I want to make what I call, in quotes, impact statements. I've been doing this since '82, and I haven't used the word impact, and I don't think people have been listening. I mean, if 75% of the money that the public has put in this market in '86 and '85 and '84 has been in fixed income, they really, really haven't been listening. That's unfair. I think they have been listening, but they've been frightened to act. Now, our confidence in this bull market can be expressed in one way simply, and that is this. You live in a bull market twice in your whole adult life. So when I say you are going through the greatest bull market in history, you only live in one twice. So if you don't act now, you've had it, especially if you're my age. If you're younger, at least you're going to understand it so the next time around you won't blow it. The second statement I want to make before getting started is this. Wall Street is the best game in the world. And if anything, it's probably a game that can be played really for the best potential. If you look at the international market versus the U.S. market, the valuation clearly is in the U.S. market versus any international market in the world. If you look at the games people played in the last few years for appreciation, it was real estate. The game is over. Again, the only game in the world is Wall Street. So what we're saying is that not only do you live in a bull market twice in your lifetime, but you're treated to being in the area where it's happening. And I don't care whether you're looking at a boob tube from Indianapolis or whether you're sitting in New York City. The facts are clearly in front of you. And hopefully, before I get done, that confidence that I'm looking for everybody to have will make more sense. Certainly, it will build on what we said 13 months ago. Now, let me go in now to the economy before I go into the financial markets. Last year, when I spoke to you, I said that since October of '84, which is a little over 2 years ago, the Federal Reserve under Paul Volcker had one simple aim in life, and that was to allow interest rates to drop to whatever level was necessary to lift this economy. The bottom line is, if you look at the numbers, this is exactly what he's been doing for 2 years. He's been allowing the interest rates to drop. When you look at the discount rate or the Fed funds rate, we cut it 4 times in 1986 alone. We took a short rate down from a high level to now where it's 5.53. You know what's happened to the long rate. We've come from over 10 to 7.25. Clearly, we've dropped rates. Has it worked? To everybody's surprise? Absolutely. When you drop interest rates, you stimulate the system. And that's exactly what's happened to us. We dropped the rates, and although you might not believe it in reading it in the paper, what we have in effect done is created a demand for cars, for housing, for suits, for appliances, for everything in the system in the first 3 quarters of 1986. The March quarter, the June quarter, and the September quarter. Real growth in this country of ours was between 4 and 6%. Real growth, each quarter, 4 or 6%. The problem relates to when you look at the bottom line. The Japanese and the German get 4 or 5, and we get 1. It's just that simple. The demand of 4 or 6% came in Japanese cars and German cameras and machine tools from outside this country, all the way through for 3 quarters. And then all of a sudden, as simple as sitting right in front and understanding it, Volcker says, time out. Game's over. Am I going to be stupid enough to cut the discount rate again? Raise the money supply, allow the consumer to borrow right up to his ears, and then have the demand come in at 4% for a Japanese product or 5% for German products, and we get 1 again? No way. So what has been happening in the system the last 3 months, economically speaking, is we have made a decision to roll our economy at 1 or 2%. And we're saying to the rest of the world, get your act together. Japan, no more kabuki. The game is over. You see, starting in 82, I suggested that never look backwards, because what you think would happen as the basis of history won't happen. And little did I know that when I waltzed through 86, that statement would come back to haunt me. You see, when we drop interest rates, normally the rest of the world drops interest rates. When we raise money supply, the rest of the world raises money supply. But that didn't happen. Japan is sitting there in their little tower, and they're saying, hey, wait a second. If these turkeys want to raise money supply and drop interest rates and create a demand of 4 or 5 or 6%, if we get the bulk of it, what do we have to drop interest rates for and lift our economy? We'll leave our economy in a low profile and catch all of our growth in the international arena. And that's what they've been doing. And then all of a sudden, the other side of the coin, when you look at the patterns that develop over the years, whenever the dollar drops in value dramatically, the rest of the world's product is out of line in price. Why aren't they out of line this time? The dollar is down 42% relative to the yen, 38% relative to the Deutschmark, and yet the imports are more competitive now, or at least as competitive as they were in the first 3 quarters of the year. Why? Because they didn't change the price structure. The dollar goes down in value automatically. The Japanese should have raised the price of their product because they were translating into a different yen relationship. The same with the Deutschmark. But they didn't do it. They said, wait a second, these guys aren't going to run at a low profile. This is something temporary, a month or 3 weeks. So what we'll do is we'll keep the price structure in a low profile. When we translate at 158 yen to the dollar instead of 180 yen to a dollar, Toyota loses their shirt. But what do we care? We'll lose money for a couple of months, but we'll hold on to our share of the market. And now all of a sudden, the light bulb is going off all over the world. We're saying to the rest of the world, wait a second, you're going to play by our rules. You're going to raise your money supply. You're going to drop your interest rates. You're going to cut your taxes like we did in December. And by the way, while you're about it, you're going to start raising your price unless you want to lose your shirt for the next year. That's the game we're playing at this point with these guys. Do you think it's working? You bet your bippy it's working. Look at the unrest that's beginning to develop in Japan. Look at the unemployment building. We wanted to keep the yen to the dollar relationship between 160 and 180, hopefully towards 180. And where is it today? 158, going down, going down. You pick up the paper in the last month and a half and you read 3 letters, EMS. You haven't read about European monetary system crisis in the better part of 4 or 5 years. What does it mean? It means that the valuations in those currencies are out of line relative to the dollar as it's falling. What are they trying to do? They're trying to revalue the German mark up. What does that mean to the price of their exports? You think they're going down more or going up? That's the ball game. And the only way around it is for these guys to begin thinking about dropping their interest rates and expanding their system. So in effect, what we're saying is something very simple economically. We're saying, folks, until our exports pick up dramatically, we're playing hardball with you guys. And the only thing we're concerned about is making sure we have enough juice in the system so we don't create a recession. It's just that simple. And so don't be surprised as the pressures develop in here. It's no accident that Japan cut the discount rate 4 weeks ago. It's no accident that they put $25 billion into a public works program. It's no accident that France has reduced its taxes for the individual and corporation. The process is beginning to unfold. It takes time. Germany is still trying to play hardball, but the ball game is going to be different. They better start understanding what's going on, which I think they will. And so what I would suggest to you is we're going in from an economic point of view, low profile first half of the year, accelerated economic activity in the second half of the year, led by the change in the trade deficit, continuation of the consumer spending on a little bit lower profile. The banks are going to give them all the money in the world. They're not going to put it in agriculture or energy or Argentina or Japan. They're going to say, here you are, guy, you want the money, go spend it. Only the guy's going to hold off for a while. He's built up a tremendous amount of debt, and he's going to slow it down here in the first half of the year and then start in the second half of the year. Watch for an inventory build. Not a final thing on the economy. Again, anticipation of change. Anybody who's been listening to me since '72 knows that we have a pretty good record in terms of anticipating major trends. It is no accident that chemicals, papers, aluminum, certain technology companies are behaving better in the marketplace today than the consumer non-durables, beverages, cosmetics, tobaccos, and what have you. The market is telling us something is coming. Most companies in the technology or the basic industry on a relative basis are selling right down on the bottom. People have avoided them, and that for good reason. They say, if we change the tax code, how in heaven's name can we expect an investment cycle in this country? Corporate America is going to stay back. All right, let me suggest what's coming up in front of you. You watch the papers. You be the judges of whether I'm right or wrong on this. Number one, the buzzword in Washington in the next 6 months is going to be, quotes, competitiveness. It's going to be an offset to the growing level of protectionism that's developing all over the system, especially in industrial areas where people are getting eaten alive by imports. So we're going to start this routine talking about competitiveness. We got to get more competitive on a world basis. We got to break, because with the value of the dollar down and these folks having to raise their price structure, price-wise, we're going to be a lot more competitive in '87 than we were in '86. But the next stage of competitiveness is more important. And it's very, very simple. It's investment per employee. The next stage of efficiency is putting money into your operation so the people that are still left will be working more efficiently. That's where we're going in '88 and '89 and '90. That's going to create the dynamics of '88 and '89 on our real GMP. We're on that track. The market is suggesting we're on that track. And it's just a case of Congress getting their act together and doing something nobody in the world expects them to do. And that is create an incentive for a major investment cycle. Now, you watch the competitiveness, protectionism, watch the rounds going for trying to create the incentive, and see if I'm not right that that's on the way. Now, while all this is going on in the system, one other thing with respect to the economy. Whether you realize it or not, the federal deficit is in a process of improving. The last 12 months, government spending, the rate of increase was the lowest in 20 years. Only it was hidden by the fact with a slow-growing economy, the revenues going into the government to offset one side of the deficit equation weren't big enough. And so the end result is the Graham-Rudman thing is working. When you see the new budget and the fact that defense is lower than what they expected and the pressures are on to keep the lid on spending, once you get the economy rolling and the revenues come in, then the deficit is coming down dramatically in 1988. So the process in place, has it taken longer than I expected? Absolutely. I mean, I thought this thing would have been started in 1986, but it's just taken that much longer. Again, more so because of the trade deficit and the impact of losing the growth to the international arena. So I think that, as we go through this giant bull market, I don't want to hear 12 months from now, oh, gee, Jack, I didn't know the trade deficit was going to improve. Oh, gee, I didn't expect the federal deficit to finally bend down from $210 billion. I thought it would go on forever. That doesn't happen when you're in a bull market. When the problems develop, they go away. They go away. Now, let's turn to the financial markets. First and foremost, the market has a head of steam. Anybody that has listened to me in the last 6 months have heard me telling you that the turkeys that are looking for a 15% correction are whistling in the graveyard. In other words, the only time you will get a correction of the magnitude of 10 or 15 or 20% is when nobody expects it. When everybody out there looks at the market at 17 and 18 and 1900 and says, ooh, we're coming into a correction, forget it. It never happens. In 37 years in the business, we never accommodated anybody. When everybody is going in this direction, they wake up and look back and they're by themselves. So what I've been suggesting to people is the market at a minimum was going to 2000. Now I'll give you one more step. We're probably on the way, before any correction whatsoever or any wrinkle in the market, we're on the way to somewhere between 21 and 2200. The momentum in here is extraordinary. Could we get a wrinkle after that? Absolutely. It could be due to the foreign currency thing. It could be due to the fact that in playing hardball with Japan, they decide not to fund our deficit. I don't know what it is, but whatever it is, it's temporary. And whatever it is, the market at the end of the year will be higher than it was Friday. You want to play that game again? You want to play the game of trying to bet in a down market that I'm going to invest? I'm going to leave one thing with you. This is a picture of the bull market. What it is simply is every single month, the 55 of them of the bull market since July of 1982. You see those little yellow lines on that sheet? That's 14 months. You know what it represents? The entire move of the market. The entire move. If you weren't in the market these 14 months, kiss your performance goodbye. You wouldn't have made it. Now, when you look at this sheet, and I'm leaving it here and you can Xerox it, you have hindsight. I can look at all these months, and I'm going to be smart enough to go into the market just when a correction occurs, just when it's starting. And what I want 3 months. No, maybe I want 6 months when the correction starts. You know what? Add it up. What you've had in 3 months is a lousy 5% correction. The most that you've had in 6 months is 7%. So and incidentally, just so people understand what I'm saying, yeah, we had a month in here where the correction in September was 8%. But on one side of it was a 7.4% upside, and on the other side of it was a 5.7% upside. So now you're going to play a 30-day game. So what you've been doing for 4 years is playing for a 5 or 7% correction while the market's gone up 185%. Does that make any sense? You only live in a bull market twice. Don't play this game. Don't play it. The worst thing you could do. Now, before I conclude here, in terms of what I see as the factors that make me so confident about this 3,500 market, I'd like to make a simple observation. I mean, you know, I've been doing this straight for 4 years aggressively wherever anybody would listen, whether it's a conference call, on a telephone in my office, or whether it's in front of a boob tube. It has been my experience that we at Lord Abbett have been so strong and visible as equity managers. I mean, we pull this thing all the way through with confidence, that I begin to think that people don't know we manage fixed income. As a matter of fact, if you look at our municipal bond funds, our high-quality government bond fund, and our lower-rated bond fund, which came out in '71 and was the first one in the market, we have an excellent track record in fixed income. Outstanding. And what I would like you to do is think about it for a second. If people are going to buy fixed income because they're nervous at the market at 2000, please put them in Lord Abbett. At least they're going to have the switch alternative. They'll be able to go right into affiliated fund by pushing a button. So if you're looking for an avenue, at least start that way. I'd rather see them start with 10 or 15%, bing, right in equity. Last year, affiliated fund, it was up 23%. The average shareholder, 19 years. He has never been treated to a bad experience, or I should say an experience he didn't expect. The worst bear market was a 42% drop in '73, '74. Affiliated fund went down 19% in the worst bear market. So he's been, and if the market goes down after it hits 2,200, he's going to be treated to a good experience. So look at our bond capability and maybe start on affiliated fund. Now, why the confidence? It's simple, absolutely simple. Number one, inflation is under control. It has been coming under control since August of 1981. Could it wrinkle up a couple of percent, go to 5% in some 5 or 6 month period? Absolutely. If the import boys raise their prices and our corporate America decides that they got an umbrella where they can lift prices a little, we could get an inflation scare, but that's all it is. It won't last more than a couple of months, and we're headed right down again. We're running at inflation at 2 or 3% for the rest of the decade. This, and I don't care how you measure it. You go to Economics 101, if you took it in high school or college, what is inflation? Cost of money, cost of labor, cost of raw material. Where is the cost of money when a long bond goes from 4 to 7, up or down? You tell me. Where's the cost of labor when it was 10% and AT&T sold for 2% per annum last year for 3 years? You tell me. Look at commodity prices other than gold and silver and tell me where they are. So if we got ample supply of product all over the world and the cost of money is coming down and labor ain't going anywhere, where's inflation going to go? Other than some screwy scare because we're buying Japanese gold coins for Hirohito or some stupid thing like that. Inflation is dead. What follows from it? The second point, the secular trend of inflation of interest rates is down. What are you and your client going to do when he sees a 4% long bond in a couple of years? We're going there. He's going to say, oh my God, where's my total return? He's not taking the money out of the bonds. He's reinvesting it. He wants a total return. We're heading to 4%. We're hiring them. Look at last year. Good example. He doesn't know that yet. He's had a great experience, incidentally. I mean, money market funds all the way from 74 to 81. Government bond funds from 81 right through last year. Even last year, he had a great experience. That's why he's sitting on his hands. Well, why don't you let him know? Last year in the government bond market, he made 12 or 13%, but he could have made 20% in the equity market. And even after any kind of a wrinkle in here, when you start running towards 27 and 3,500, the whole game is going to be equity. He's coming into that arena as sure as you're sitting in this room or listening to my voice out in the field. So the secular trend of interest rates is down. Third, something that didn't happen last year. We got a new tax bill. What does it mean? We're getting rid of all the loopholes and we're putting the money in the individual pockets. He's going to do one of two things or both. He's going to spend and invest. So we're going to put more money into the system, financial markets, as a result of the tax change. What do you think the tax change means for tangible assets? Do you think you're going to see as much money in the real estate game in the next 4 years as you saw in the last 4? He doesn't have an inflation ride, and Uncle Sam isn't going to pay him. Who's going to fool around with real estate? The Japanese are doing it because they don't know what to do with the money. That's why they buy Exxon, the building. So that game is over. So what does it mean? When somebody pushes the greed button and says, I want to make money, they're not going into real estate, they're going into the financial markets. In effect, the tax law is shifting us from tangibles to the intangibles, bonds and equity. It's just that simple. I mentioned this a year ago. If I go to the top of the last bull market in 68, and I say, okay, I want a picture of every individual in the United States. And I just want to look at 4 things. I want to look to see how much money he had in checking, how much money he has in savings, how much money he has in all kinds of fixed income instruments, and how much he has in common stock. Just those 4 items, financial assets. I don't want to know anything about his Queen Anne tables or his Japanese ceramics or his gold coins or his Tahoma real estate condominium in Florida. You know who he's going to sell it to. I can guarantee you that right now. I don't want to know about that. I just want to look at 4 financial areas. I want to know when I put everyone in the United States together, how much have I got? December 1968, $1.9 trillion. 45% of which was in common stocks at the top of the last bull market. Now I want to roll through history and I want to look. Checking, savings, fixed income, and equity. Same 4 areas. Same people in the United States. The older people, young people involved in everything. Just look at the individuals in the United States. Latest numbers, June 30th, 1986. Right out of the Federal Reserve Bulletin. The individuals of this country have $8.7 trillion. 4 times as much money in financial assets. You know how much is in equity? 27%. You know how much is in fixed income? Over 40. And long rates are going to 4%. You tell me this is the end of the bull market? We haven't seen it yet. It's only started. The time to worry is when the 40% in fixed is 40 and 45% in equity. The party hasn't even started yet. Then you take the next dimension. We have $170 billion in trade deficit. You know what that means? It means there's $170 billion US dollars flushing around the rest of the world. They don't know what to do with it. You're sitting in Japan. The price-earnings ratio of a stock is 40 times earnings. The PE ratio in the United States is 15. Where are you going to stay? In Japan or go to the US? You tell me. The whole process is simple. You look at every single dimension and we got it nailed. All of a sudden, you see these guys coming in buying buildings. You see these guys coming in buying Celanese, buying all of our companies. You're going to see them come in and build plants in this country. I mean, if I was in Japan, I'd build plants all across the middle section of the country. What do I want to worry about the exchange rate and the value of the dollar? What do I want to worry about what's going to happen in Washington in terms of protectionism? I'll build a car in this country and ship it under a Japanese label. Do I care? Heck no. We'll create jobs here. They'll buy our steel, our aluminum. They're not going to ship the steel from Japan. They don't have the aluminum. We'll benefit that way. The system is in the process of working all the way through. Now, I'll close on this simple comment. You're looking at the market rolling along. You're seeing 150, 200 million share days. One day last week was 260 million. They couldn't get in fast enough. A year ago, it was 100 million, 110 million. Now you hear the boobs on the TV and the radio talking about a ho-hum day being 140 million share day. You know, in 1972, we had 7.2 million share average trading. Think about this. Think about this. If we have 150 and 200 million share trading days, we're having it in an environment when nobody knows what the heck is going on. They don't know the trade deficit is going to change. They don't know the federal deficit's coming under control. They don't know we're not going to have a recession. They don't know corporate earnings are going to go through the roof as soon as you put 2 or 3% momentum in there. Can you imagine what kind of volume we're going to have when everybody knows where we're going? It's common sense. You're going to have 5, 6, 700 million share days. You're going to have absolute panic. And it's going to happen in 88 and 89 as sure as you're listening to me. So please, develop the confidence that I have. Look at the benchmarks about where we're going. Understand the mechanism. And for the moment, participate. Enjoy it. The only way you can is by buying stock. Thank you very much.